Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. Our guest today is Anthony Vicino. And Anthony has quite a story to be able to share with us here today. 10 years ago, he was living in the back of a van parked in downtown Oakland with $80,000 in debt and zero clue on how to get out and on his way. Since then, he has acquired has written a dozen best-selling books, built to 8-figure companies, and acquired $70 million in real estate as a co-founding partner of Invictus Capital. And he did this all by turning his ADHD into a superpower. Now Anthony was living a life of relentless pursuit of less and better. I can't wait to dive into that piece as well. And is committed to helping investors and entrepreneurs do the same so they can maximize their return on life. So Anthony, welcome to the show.
Yeah, thanks for having me, man. It's good to be here.
Yeah, if we could maybe just start with your background and kind of where you grew up and what eventually led you to real estate. And of course, want to hear about the being $80,000 in debt and living in the back of a van.
Yeah, that's the part everybody is always interested in. There's two parts of the story people like to focus on. They're like the rock bottom moment and then the highlight reel of like, oh, how did you get from there to here? But I mean, I wasn't born just in the back of a van. So there was a lot of stuff that kind of led up to that moment. And most of it revolved around the fact that I have really, really severe ADHD. And for a lot of my life, that was just the defining characteristic as something that was my limit, like my weakness. I couldn't focus. I couldn't be reliable. I couldn't be consistent. And it was like this really easy crutch to lean on and be like, oh, I have ADHD. This is why, because, I bought into the narrative that it was a limit. And all through my 20s, I just kind of lived my life believing that truth about myself. And so my results really reflected it. I went into different jobs thinking I can't be focused, I can't be reliable, I can't be disciplined. And so I'd get fired all the time. Same with school. Like I was like, I can't be consistent enough with my studying. I can't do the homework and everything. Like I don't have that ability. And so I struggled through school. And the same with my relationships. Like in every different aspect of life, I just kept running up against my limits, or at least my perceived limits. And it all came to a head in my late 20s. I was, at the time, a professional rock climber, which sounds way cooler than it was in reality. Like it just means I just slept in the dirt a lot and climbed on rocks and made very, very little money. But I got to live with complete freedom, kind of just doing my own thing and indulging my highly distractible, dopamine seeking brain. And I was fine on that path until I tried to marry this woman, and I went to her parents and I was like, hey, can I marry your daughter? And I sat down with her mom, and her mom looks me dead in the eyes and she goes, how are you going to provide for our daughter? And it wasn't like a softball question. Yeah. Like, here, let me just throw one out. She's like, I believe in you. So like, give me a good answer. It was legitimately like, I don't want my daughter to marry you because you are going nowhere in life. And so I left that conversation with a big chip on my shoulder being like, you know what, screw that. Like I'm going to show you what I can do. And so I was like, who makes a lot of money? And at the time I was reading a lot of science fiction and fantasy. So I was like, you know who makes a lot of money? Stephen King, J.K. Rowling. And so I left that conversation and my delusional brain was like, I'm going to be a science fiction writer. That's what I'm going to do. So the next day I sat down and started writing, and every day for the next year, I wrote 3,000 words. And then about 6 months after that, had my first book published. And that was all great. But at around that year mark, the woman that, was my fiance, she decided to call it off one day. And this is where everything really takes a turn and goes to rock bottom real quick, because she kicks me out of the house. I have maybe $3,000 to my name and $80,000 of debt, nowhere to live. And so
oh my gosh,
I call my dad and I'm like, what do I do? And he's like, well, you're used to sleeping in the dirt. So why don't you just go buy a van and live in the back of a van? So that's what I did. I went to Craigslist. I found a church that was selling this 13 passenger van for like $1,000, half my life savings. And my dad came up, he drove me out to the church to get the van. And then that was my home for the next 5 months. And while I was in the back of that van, life was really rough. I was really wondering, I'm like, how did I get here? Like, this isn't how I saw my life playing out, right? Like nobody ever thinks this is going to be your, how it all comes together. But what I didn't realize is that like rock bottom is a really good place because you're motivated by desperation to try anything. And so I was open to the possibility of trying something that I had never done before when a buddy approached me and suggested that we start a business together. And before that, I was not an entrepreneur. I was not like the kid with the lemonade stand. I was not plucking flowers from the neighbor's yard and selling it back to them. That wasn't me, but I was willing to try. And so we started a window washing company, and it turned out like that was a very good use of skills. There's this beautiful intersection between what we were good at and this new world of entrepreneurship. And it set off this love affair for me with this idea of building things that deliver value to the world. And that's what we've been doing for the last decade now, is just jumping from business to business in different verticals. And the most recent manifestation of this has been real estate, because as those businesses started doing well, I had this problem, which was, okay, now I figured out how to make money, but now I need to figure out how to manage money. And those are very, very different things. And as I was asking all the people in my life, what do you do with this money that you're now, you're doing? What do you do with this? Everybody was telling me the same thing. They said, just park it in real estate and forget about it. So that's what I did. Like starting in 2012, 2013, started buying triplexes, little small multifamilies with my own money that I was just kind of managing myself with my own little in-house team. And I did that until about 2019, when I was having a lot of friends and family and just people in my life coming to me asking about how I was building this portfolio. Like they were interested in real estate, but they weren't really sure how to get involved in it. And so that really was the start of Invictus Capital, where we started bringing in investors into our deals and offering private placements where our friends and family could get into these opportunities with us without having to do any of the work. And so since 2019, we've acquired around 75 million in assets. The thing that makes us weird, I guess, in this space is that we're vertically integrated. So we have our own property management team running our assets day to day. So we're very, very involved in the leasing, the renovations, the maintenance, everything that goes into actually operating the building. And then on the other side of it, we don't really partner with other GPs. We don't partner with capital raisers to fund our deals. And so we are the ones that work directly with our investors and directly with our residents, which just is a little bit weird, a little bit unique in the space. Not a lot of groups do that, but it's worked really well for us so far.
Yeah, I like that. I think it gives you a level of control that you just don't have when you use third party. But not everybody can do it. It's a lot easier just to get a third party than to actually have in-house property management. So on these 75 million worth of multifamily, I assume when you say multifamily, mainly apartment complexes, what area are you investing, and what does that look like as far as your buy box? How many units are you looking for? Are you looking at value add? What is the formula there?
Yeah. So what makes us, again, a little bit weird or special or unique, however you want to look at it, is that we only invest into our backyard of the Twin Cities, Minnesota. So St. Paul, Minneapolis, first ring suburbs. And then the reason for that is, one, it's a really great market, but two, it's our home field. So we have home field advantage, and we can do things that a lot of other groups would have a difficult time doing if they're coming in from out of state. For instance, our buy box is anywhere between 20 and 100 units, but usually it's more like 80 units. And so what we like to do is find buildings, maybe a 20 unit, 30 unit, a 50 unit, that are geographically linked in some meaningful way. Maybe they're on the same block in the same neighborhood. And now we can treat these as though they're one large compound. Our maintenance, our renovations, our leasing team, all of them, they can get the efficiencies of scale despite the fact that these are individually small buildings. And so we can get those types of deals because we have really deep relationships with the brokers and the sellers in our marketplace. We can organize those types of structures. But what it's allowed us to do is it allows us to play in this kind of forgotten middle where 20 units, at like a $2 to $3 million purchase price is a bit too big for a lot of like the duplex, triplex investors who are kind of maybe still getting into the game, figuring out how to scale. And they're like, that seems a little bit unobtainable. Whereas 80 units is a little bit too small for big institutional level players from out of state who can come in and justify third-party professional management, right? And so there is like this beautiful space in the middle where there's these mom and pop owners who've had these buildings for 20, 30 years that we can go into, we can bring our systems, our processes to the table, and we can add value. And so that's what we do. We go in there, we try to find ways to improve the property so we can increase revenue, decrease expenses through the management efforts. And then in years 2 or 3, aim for a refinance and then just keep holding these assets. And that's another one of those things that makes us weird or unique or special, is that we buy to hold for a really long time. When we talk to like the old school investors, the guys and the gals who've been doing this for 30, 40 years, when we ask them, what do they regret? They almost always say, I regret selling too soon. Now, like if I just hadn't sold that thing 20 years ago, it would have been like 10 times more valuable now. So we've taken that to heart and we're like, let's just limit how often we sell things. So whenever possible, if we need to extract capital, we do it through a refinance, which is non-taxable. It's a great way to like return equity to investors and at the same time still control the building that's cash flowing and still producing. So what we really prioritize are fantastic neighborhoods that we believe in over a 15 to 20 year horizon, and then fantastic buildings, things that are built like tanks. So the internals are probably going to need to be updated, but we need that structure itself to be built to withstand centuries. And so that's kind of the playground that we play in.
Okay. Yeah, no, that's very interesting. How about, did you start out with having all in-house property management, or is that like a process of, as you started to scale up, had started to get larger? And then I guess maybe talk a little bit about, if you have any partners and kind of how maybe you guys complemented each other's knowledge.
Yeah, so my partner, I co-founded with Dan Kruger, who we met in 2019, and he'd been on a very similar trajectory with his own portfolio, doing his own thing. And so when we got together, it was just very intuitive. He's more of like the financial analytical side. I'm a little bit more of the operations, investor management side. And what we were noticing from the very beginning, like he tried third-party management right out of the gate with his very first property, and it lasted like 6 months before you realized like this is never going to work for his personality type and what he was going for. For me, I never even contemplated the third-party route, because in all my businesses, one of the things that we've held very close to our chest is the idea that whoever's closest to the consumer wins. And so in every endeavor, we aim to cut out middle people as much as possible. And so in the manufacturing company, that meant cutting out 3PL and logistics companies and going direct to China for our supplies, going direct for the materials that we use in our polyurethane manufacturing process, right? It makes it much more complicated, makes growing a lot harder, but it allows you to grow in a more controlled and predictable manner. And so from the beginning, we knew third-party management wasn't going to be for us. So we started hiring and bringing people in. And there's really only 2 times to hire somebody. You either end up hiring somebody too soon or you hire them too late. And when you hire people too soon, it tends to cost money And when you hire people too late, it tends to cost opportunity. And so when you look at those two costs, most people say, well, because I can quantify the dollar amount that hiring too soon is going to cost me, I'm going to wait to hire, because opportunity cost is very hard to put on a spreadsheet. And so what ends up happening then is really, of those two expenses, opportunity tends to be the more expensive one in the grand scheme of things. And so our approach was hire sooner, build out the team sooner than really the assets could justify in the beginning, because we knew that in time, that team would help us scale and grow quicker, and we would do it with less headache, as opposed to if we waited until we got to a certain level where we could justify the expenses and then we try to bring in the team. And I see that a lot of people try to do it that way, which nothing wrong with it, but in the grand scheme of things, in my experiences, hiring sooner and going through that period of time where you're wondering, like, how are we going to pay the bills? How are we going to cover this overhead? Tends to be better if you can make it over a 10-year window than if you waited to hire. And so that was our approach from the beginning. We're going to build this thing, even though economically it didn't make sense in the first year or two. And years 5, 6, 7, it's made a tremendous amount of sense. And now it has become a competitive advantage that's very, very hard to compete with. And so that's kind of been our approach.
Yeah. And as far as the house or the apartments, you mentioned brokers. Is that where most of your deals have been coming from, or have you done any stuff off market? Or
yeah, no, we haven't done a deal with brokers being involved really in the last couple of years. Our approach is interesting. So in the beginning, when we were first getting into the market, trying to like make relationships, it all started with brokers, right? Like those are the gatekeepers in the beginning. You're going to get the deals. They're going to have the tours. And what we did was we would go on every tour that we could, because often on tours, one of two things would happen. One is either the seller might be there, in which case you can start talking to that person and forging a relationship with them. Or a lot of times brokers are lazy and they'll do group tours. So they'll bring in a bunch of prospective buyers to do a tour as well. Now, most people in a tour environment like that, they start to play their cards close to their vest and they're like looking at the other groups as a competition. Our approach was a little bit different, which was those other groups, if they're buying this building, there's a chance they own other buildings. And buyers eventually become sellers on a long enough time frame. And so if we can become friends with these people, then in time, if they want to sell, maybe we'll be the first people they call. So that's been our approach in terms of creating seller relationships. And it's paid us very, very well. For instance, last year, we bought 4 buildings in 2020 from a gentleman. That deal came to us through a broker relationship. We forged the relationship. We kept very, very close with this guy. He was like an old grandpa type. His kids were moved out and we, stayed very close. We hung out with him. We liked him. He's a really good person and had a lot of market insights. A couple years later, last year, he comes to us and he says, "Hey guys, I'm looking to get out of the game. I'm ready to sell my portfolio. I want to sell it to you guys." So we bought about 14 buildings from him last year, maybe around 300 units total. And that was a very easy transaction because there's no brokers involved. It's him and us. He knows that we do what we say, that we're reliable, that he can trust us. So we take that one relationship and we say, okay, well, this guy's been very, very great to us. He has no more portfolio. However, because he's been in the game for so long, chances are good he knows a lot of other guys who've been doing this for a long time, and eventually they're going to want to sell too. So we bring him onto our board of directors. Again, just a way of keeping him close, getting him ingratiated and make him invested into our success. Fast forward a couple months ago, his best friend, who's been in the game for a very long time, has about 1,500 units. He comes to his buddy and he says, "Hey, I'm looking to sell. You just sold your portfolio last year. What do I need to know? Who do I need to talk to?" And this guy who's on our board, he goes, "You should talk to these gentlemen over at Invictus." So his friend comes to us and says, "Here's my portfolio. Go ahead and pick whatever you want. And then whatever you don't want, I'm going to take to market." So of those 14 or so 100 units, we picked about 700 that fit our criteria. And right now, that's what we're acquiring from him over the next 2 to 3 years. And that's really been our acquisition strategy. There's no cold calling. There's no cold emails. It's just all relationships. And I think of what Naval Ravikant says, which is play long-term games with long-term people. And that's worked incredibly, incredibly well for us so far.
Yeah, I think it's super smart. It's a great approach. And I love the group presentations or the group tours of the property with the broker. I think there's a lot that can be gained by that. A lot of people have interest, and some of them want to have partners that, on maybe their next deal, and great opportunity to just kind of cross paths with people that have similar interests. So fantastic. What, tell me about, obviously the market has changed just a little bit over, the last couple of years, really heading into this year. What have you made any adjustments, any changes as far as the underwriting goes? What have you done differently?
Yeah, underwriting is getting a lot tighter in terms of pessimistic assumptions moving forward. Can't really make the same rent growth assumptions, expense growth assumptions with inflation being what it is, and cap rates starting to, decompress quite a lot in a pretty short period of time. So overall, the underwriting has to get more stringent to be able to factor in these things. Now, the big things for us is always when it comes to debt terms, everybody talks about interest rates, but the bigger thing for us is what are our exit contingencies. So things around interest only or prepayment penalties or length of term, those are very, very important to us, more so than the interest rate, because, they say, you make your money when you buy, and I don't believe that. I think you make your money when you profitably operate the asset and then profitably exit. And the exit is largely determined by whoever has the most options. If your term runs up and your fixed rate debt is now readjusting, you're kind of up a creek, especially given the current environment. So suddenly you go from having this asset that's maybe performing really well with your current debt structure, and now you're forced into selling. And anytime you're forced into selling means your options have been taken off the table. And that's never a good solution, or never a good option, never a good recipe for exiting profitably. So anything that gives us maximum optionality is what we look for in any deal that we're going into. And two things in particular that give a lot of optionality is abundant cash flow and ample reserves. So, cash flow is the lifeblood of any healthy business, but the more that you have, the more you can weather the midterm volatility that is going to happen, in all economic cycles. And then the reserves is, hey, listen, things are going to happen and you need to be prepared for that. And the longer you can go into the coffers, the more likely you're going to be able to ride out the other side into smooth sailing, right? If you look at 2007, 2008, the people who really got screwed were the ones who suddenly had their debt come due, or they were underwater, they ran out of money and they needed to sell. But if you could have held onto your property for the next 4 years, you would have been okay, right? But most people just didn't have the liquidity and strength of reserves to be able to make it there. And so that's something that we think very, very heavily about.
Okay. And as far as how much debt you put on these properties, or at least maybe now your mindset thing, now that things have shifted a little bit, is this, you're putting 30% down with a 70% loan to value, or what does it look like?
Yeah, sometimes. I mean, it'll be anywhere between 65 to 75% LTV. We're not afraid of going to 75 if we understand what's the downstream economics of this. And because when we underwrite, we're not really underwriting for refinances. It's something that we target in our business plan, but our business plan isn't contingent on executing refinances. If we can go in from day one and say this is profitably operational or operationally profitable from day one, which is what we look for, then we know we have the capacity to continue improving that over time. So I think right now, with where everything is, a lot of people are having to bring down their LTVs to be able to justify some of that cash flow, right? And I think that's totally reasonable. Just overall, as you're looking at numbers right now, the closer your time horizon is for when you need to get out of this thing, or when you expect to be able to execute some capital event in the form of a refinance, the shorter that window, the higher risk you have. And so if you can underwrite on a 10-year window and say, on a 10-year window, this looks good. And we don't really need much to go right in that midterm. We just need to continue kind of more or less doing what it's doing. Then you probably have the good foundation for a quality deal. Because then you can just go in there and maybe through operational efficiencies make it better. But, if you're relying on all the potential upside, you might find yourself a little bit disappointed in the next year or two, because as Warren Buffett says, if you take care of the downside, the upside takes care of itself. And so that's been pretty much a guiding principle of everything that we do, is just try not to lose money from day one. And over time, should all come out in the wash.
Yeah. Makes a lot of sense. And how long do you think these higher rates are going to last? I know none of us have a crystal ball, but just curious. I always like to get a poll from everybody.
Yeah. My crystal ball is in the shop, so it was on the fritz. It wasn't working. I think general consensus from a lot of people that I talk to in this space that are very, very knowledgeable, much smarter than me, is that they think that the interest rates are going to generally start trending downward over the next year and a half. So in a year from now, I think we'll see them a little bit lower. How much lower? I don't know. But at the end of the day, I don't lose sleep over that stuff. I think if you look at your building and you need the debt to be at a certain level to make it a quality deal, then you're already starting in kind of the wrong spot. And so the way I look at it is, okay, what's the potential upside long-term of this area, of this building? And can the debt structure facilitate that? But if you're relying on the debt structure to be a 3% or 4% interest rate so that you can get that cash flow as opposed to 6-7%, I think those are the types of deals that people are getting burned on right now as rates start to readjust and they realize the debt is no longer what makes this a good deal. The building inherently just wasn't a very quality building. Like the operations of it weren't good.
Yeah, I think there's something to be said about that. And I believe that, right now in the market where the rates are higher, if you're able to make a deal work and it makes sense at this, then there's only positive upside in the future because rates eventually will, like you said, come down, whether that be a year from now, whether that be several years from now, but they'll come back down and, the buying activity will increase. So,
yeah, there's this interesting balance where, when rates were low and cap rates were really low, then you look at it and you say, well, there's probably not a lot of appreciation potential here, right? So your exit is likely not going to be great. If you're buying at a 4 cap, it's probably not going to be a 3 or 2, right? And when you go to exit. Mm-hmm. So your potential upside over a 5-10 year window is a little bit capped. But because the interest rate is 2-3%, that means your cash flow is good in that structure, right? But when interest rates go up, valuations start to soften. Now what you start to see is you're buying into deals where cash flow from day one is a little bit weaker. But the result is that over a 5 to 10 year window, because you were buying at this softer cap rate that you think is going to firm up and start to compress over time, that means your upside is more or less pushed off into the horizon, right? And so it's two different approaches. When there's low interest rates, it's more cash flow. When it's high interest rates, it's more potential appreciation and yield on the back end. And so just like understanding that those two levers, they always kind of waffle back and forth. And I think the problem that you get into is when you buy with low interest rates and therefore high cash flow, but then you're also underwriting, assuming it's going to appreciate like gangbusters. It doesn't really make a lot of sense. Mm-hmm. And then the reverse of that is to think like, oh, I'm going to buy this at a higher interest rate and I'm going to get a ton of cash flow and I'm going to have the appreciation. Well, it's like, well, that just doesn't happen either. Like there's always like this give and this take. If you can get both incredible cash flow and appreciation, that's a unicorn deal, but that is more the exception than the rule.
Yeah, I agree. And as far as a couple different questions here. As far as your you buying it, you mentioned having a home court advantage. Can you maybe talk about some of the advantages of that and what that really equates to? Because there's I had another gentleman, I don't know if you know Devin Elder, but he's here in San Antonio, and that's kind of his philosophy. He stays in San Antonio because he knows it like the back of his hand. And, just like any city, there's good parts, there's bad parts, and there's sometimes a good part right next to a bad part, but it just depends on the side of the street that you're on. But yeah, if you could maybe give us some ideas as to, kind of the advantages that you feel like you've got because, your investments are right there in your hometown.
Yeah, you can have a great building literally next door to a terrible building. Like they can be neighbors. And we see this all the time. When you know your market intimately well, you start to recognize that building seems to come on the market every year by a different seller. Why is that? Like everybody goes into it thinking that's a great building in a great area because of these reasons. But for some reason, everybody ends up selling or getting burned on this thing. Why is that? There's some X factor there that we're not seeing that you just can't, some intangible you can't underwrite for. But because you're in that market and you see it all the time, you know this. You understand like maybe that's a building that's not the great deal that you think it is for whatever reason. Maybe you can identify what it is. Maybe you can't. And so generally in business, whoever has the most information is in the highest leverage position. And when you live in a market, you drive the streets every single day, you have asymmetric knowledge about that market that you really can't get from Google Maps, city data, and talking to brokers on the phone. Like a week trip to any city is not enough to really understand the fundamentals of it. Going so deep as to understand, okay, who are the city council members in this particular ward? What are their politics? What are they leaning towards? What are they pushing? And when you're only in that one market and you're in your backyard, you start to forge these really deep relationships with the leaders of the community, with service providers, with brokers. And so all of these things, they compound over time because real estate is really a relationships game. And you can call a broker from out of town and you can hop on Zoom meetings and whatnot, but it's never going to be the same as being in the same market and going to get coffee and walking the street and running into like your local city council member and be like, oh, hey, let's talk. Right. So those are the types of advantages that you don't see them on the spreadsheet, but they end up being massive in the long run.
Yeah, that's perfect. Anything else as far as like the value add piece of the puzzle? Is there? I've heard of a lot of folks, kind of renegotiating deals with cable companies, doing different things to kind of find that additional income. What are there any strategies that you've been successful with when it comes to adding NOI?
The way that we think about it, like the best piece of business advice I ever got from a mentor very early in my career was that a dollar saved is always worth more than a dollar earned, because a dollar earned is always on a margin. So if we can bring in an additional dollar of revenue, let's say we're operating at a 50% OPEX, then that means 50 cents actually makes it down to my NOI. Whereas if I can cut a dollar of expenses, that's pure saving. That's a pure dollar to NOI. And so we focus a lot of time and energy on the expenses and saying, how can we run this as efficiently as possible? Now, you can only do that up to a certain level, obviously. Like beyond a certain point, you start cutting expenses too much, you're now anemic, and now the organism is going to die. And the plus side of revenue is that potentially it's limitless. So there's a ton of upside there. But our approach is always get in there from day one. It's put into place those operational efficiencies as quickly as possible. And then let's let time do the heavy lifting on the revenue. Because when you have a decade to work with, rather than needing to get in there in a 2-year window and get rent increases 15% every single year so that you can execute the refinance, when you let time do the heavy lifting, the revenue is going to take care of itself. And so that's been very much our approach. We go into our buildings, and instead of trying to get all the renovations and units turned in year one, we look at it as a 3-year window, because we see organically about 30% of our residents turning over every year. So 30% of our resident base will move out, go somewhere else. So when they do, that's when we go in, we do the renovations, we bring rent up to market. But we're really trying to minimize churn in that equation, because instead of going in and deploying all of our reserves and CapEx budget in year one to do all these turns, if we can wait until years 2, 3 and keep our vacancy very, very low in the meantime, that's what we're going to do. And we've seen it work really well from a business plan perspective, but then also from just not being disruptive to the neighborhood and the community at large. Like there is no surefire way to make yourself disliked in the community more than being the landlord that goes in and starts jacking up rents on people and disrupting the community. So the more that we can integrate ourselves into our neighborhoods in a way where we're bringing value, we're working with our residents to bring these up to market rent over time, but not doing it in a traumatic, volatile way that displaces families, that's what we're going to go for every time.
Yeah, perfect. And on the 75 million of apartments that you own, how many units do you think you have total?
So right now we have about 550 or so, and then we have about 700 under contract. So over the next 2 years, these are lined up transactions. So we'll be a little over doubling in the next year or so.
That's interesting. Tell me a little bit about that. How did you accomplish that?
Well, so that one came as a result of that relationship, right? The seller who is selling his portfolio. So we really lined up, okay, when do you need to transact? Give us time on this, because we have operations in-house, we can't just throw $100 million of assets on the team without the team growing proportional to take on that work. And one of the hardest parts of any business is always people. So your team, growing those rock stars, that takes time. And so we're spreading out these acquisitions over the next year and a half, 2 years, so that we have the time and the capability to bring on the team and hire them at the right rate so that they can operate these assets without any loss of capacity in the meantime. The last thing that we want to do is overwhelm and stress our team to the point where we're too far over our skis and they can't keep up with the workload. So it's all about implementing the onboarding over like a longer time window.
Yeah, I think that probably works well for the seller as well, not having to take capital gains all in one big lump sum and just kind of staggering it out across a series of years. So that's smart. I love that.
Crazy things with that too is that we're doing a lot of seller financing. So, we have a couple of loans where it's just 4% interest only period for the entirety of the loan, which is, there's currently no term set to it because he doesn't need the capital, right? Like this whole portfolio will transact probably for $150 million. There's really nothing that he needs $150 million for. What he needs is ongoing cash flow. And if anything that he can do to limit his tax liability in the meantime, and we can help facilitate that, awesome. So if that means we can get 4% interest only into perpetuity on a building, yeah, we'll take that all day.
Right. Yeah, for sure. How about as far as benefits for the investor? Do you take advantage of any of the cost segregation studies, the depreciation? What does that look like when it comes to the investors and how you pass that down?
Yeah. We do cost segregation studies on everything, on all our buildings. Typically, what that will look like is somewhere between 40 and 60% of initial invested capital gets kicked back to the LP in the form of passive loss in their K1. So if you invested about $100,000 into a deal, you'd see somewhere between 40 and 60K showing up as a passive loss. That's actually a little bit less this year. That was in previous years where we could take 100% accelerated depreciation in year one. Right. Now it's only 80%. So that's it'll probably be a little bit less than that moving forward. But that all gets passed to the investors on a pro rata basis. Very, very beneficial for them in terms of being able to offset the tax liability associated with their cash flow distributions. So that's awesome. They can also use that to, if they're a real estate professional, they can offset their other income as well. But most of our LPs don't qualify as RE professionals. So that's not necessarily a strategy that they can fully utilize. Something else that we're doing with all our assets, Twin Cities is unique in that they have a couple of programs that are like tax abatement programs. So there's one in the Twin Cities called 4Ds, which pretty much allows, if you keep your assets and your rent under a certain level over a 10-year window, it allows you to reduce your property taxes by about 40%, which is a very significant amount of savings, considering that property taxes and insurance are your two biggest line items typically. What's interesting about that is that the threshold set for market rent, I don't know where they generate these numbers from, but they're very, very high. So it's almost as though they're using like low class A, high class B rents for class C, class B affordable living measures. And it's really interesting for us because even over a 5-10 year window, as we're projecting rent increases, we're still well below those thresholds. So that's a program that we utilize on our assets. And it's something, depending on the city that you're in, it might be worth looking into, like knowing the nuances of those types of programs. Again, having home field advantage gives us access to this because city council member came and said, "Hey, are you guys using this? Like, it's a really crazy program." And we're like, "Oh, cool. Thank you. It's great to know." So
yeah, no kidding. That's kind of the best of both worlds. If you know that, it's going to be your rent increase is probably going to be below what their requirement is anyway. And then you get the tax advantages as well. So just kind of double dipping there, which is great.
Exactly. We're looking at it. We're like, we weren't ever going to hit those rent numbers. Like those are crazy numbers. So sometimes that happens depending on your market. So definitely don't just write off those types of programs because we wrote it off for years. We just assumed like, oh, we don't do affordable housing, like, and we're going to be underneath, we'll be like way over that number. Then when we actually looked at it, we're like, oh, wait a minute. Like this is no problem. We're way under this. So it makes a lot of sense for us.
Yeah, for sure. What about the Twin Cities in general, as far as the economy there, and what's that like? And is there a lot of growth, or what's really happening out there?
Yeah, Twin Cities is a fantastic market that a lot of people are not aware of. And there's a couple of reasons for that, I think, but generally, let me just paint the picture of how awesome the Twin Cities are. And granted, I'm biased, so this is me on a soapbox. We have more Fortune 500 companies headquartered here per capita than any other city in the U.S. So we have 15, and they're over like a very, very wide economic base. So we're talking, General Mills, Best Buy, Target. We have the largest privately owned company in the country, Cargill. Right down the street, we have the Mayo Clinic. We have the University of Minnesota, which is the third largest university in the country. All of these things kind of compile together to create a very, very stable economic base. And what that means is that when you look at the performance of the Twin Cities over a 40-year window, it's almost every single year, 3 to 4% growth consistently. Like it just never stops. It never goes down. It just keeps ticking up. Now, that's not the type of explosive growth that you're going to see in Phoenix or in Austin, right? But you also don't get the volatility of like the steep drops either. And so for us, we look at this and we're like, we can pretty much set a clock to this, knowing that this is going to continue performing in the same way over the next 10 years. And that's what we really like. We like to have that stability. And then you look at other reasons like that the Twin Cities are just generally awesome in terms of like, we're considered a lot of times like in the top 10 for healthiest city in terms of quality of life. We have a very high average income, and compared to the cost of living, it creates a very, very high affordability index. So all that really means is that people just have more disposable income to go around up here, which is nice, because the more disposable income that you typically have, the more features, we'll say, of the city that make it attractive. So all those things kind of compile for us as a market that's very, very compelling. But I think a lot of people sleep on it because, one, we're Midwest. Two, it gets really, very cold up here. So a lot of people assume that we turn into like the frozen tundra in the winter, which is true. Like it's horrible in January, February, and everybody just assumes all our pipes are freezing and busting. And that has never happened to us yet, but knock on wood. What it does mean is that utilities get a lot higher in the winter times. So just another underwriting headache. But if you look at it from an insurance standpoint, there's really no natural disasters that occur up here. We have blizzards. That's not really doing any meaningful damage to a building. We have some tornadoes occasionally, but compared to like what you're going to see down further in the Midwest or going all the way down to Florida with, hurricane season and everything, like just a lot that's going on up here where you can predict pretty reasonable the growth and the potential downsides. And in our estimation, it's a really good ratio of reward to risk.
Yeah, I think so too. I think just the steadiness of the population growth, the job growth, that gives you a really nice base to be able to build your business plan off of, knowing that you're not going to have huge swings one way or the other on that side of things. So fantastic. Well,
I was just going to mention,
ahead.
Keith, you probably saw this. There was a report. I can't remember who issued this, but last quarter was like the first quarter ever where like the Midwest outperformed every other sector every other region in the U.S. And the impetus behind it was, if you look at 2020, 2021, 2022, there was a ton of growth in all the markets, like the South and the West Coast. They were just going gangbusters, had really great years. And then in 2022, 2023, you just saw this big, steep decline as that fast growth kind of led to fast loss, right? And in the Midwest, if you look at it, it never really did anything all that sexy and interesting during those high growth years of 2020, 2021. It just kind of like kept chugging up. And then in 2022, 2023, when all of a sudden all the other sectors are falling, the Midwest just kind of keeps going up. And so for the first time, it took the crown as like the most growth. It had never done that before. But it wasn't because we had a ton of growth. It was just because we didn't lose anything. We just kept going. So it's one of the things I just really like about the Midwest. I think a lot of people aren't aware of like generally how awesome, not just Minneapolis, but places like Kansas City, Indianapolis, Des Moines, Omaha. Like these are fantastic places.
Yeah, for sure. Well, why don't we maybe tell the audience how people can find out more about you if they want to do some investment with you as well. That would be great. And then I'm going to ask you about your books and I want to hear a little bit about the ADHD and kind of your relentless pursuit of less but better. I'm interested to hear that.
Yeah, absolutely. So, something that we haven't talked about here is that we wrote a book about 3 years ago, and it's been in the top 10 on Amazon ever since it came out, which has been amazing to see. It was a book that we wrote specifically for the average recreational passive investor, somebody who does not live and breathe real estate. They don't want to do the operations, but they want to invest in private placements, in syndicates. But they don't want to get a master's degree. So we wrote a book called Passive Investing Made Simple. And what I would say is if anybody's listening to this and you're interested in investing with us or learning more about what we do, I'd highly recommend you start with that book. And I'll make you guys a very very special offer. If you guys go and leave a review for this podcast, wherever you're listening to it, on iTunes or Spotify, just drop a review and then shoot me an email. My email is anthony@invictusmultifamily.com. Just shoot me an email, say, hey, I left a review for the podcast. I'll have somebody on our team fire out a physical copy of the book to you. So you don't have to pay for the book or anything like that. All it costs is just go leave a review. And then if you're interested in learning more about what we do on the investment side, just go to invictusmultifamily.com. You can request an invitation to join our investor club. It's very full at the moment. So we're taking people kind of on a waiting list, but if you want to get, on that list, then definitely go to the website, hop on a call. We'll get your name in the pool.
Oh, fantastic. No, I appreciate that. I'll have to send you an email with my information too. Of course, I'll give us a review. I'll give us a review as well. So
get on a podcast. I understand. So anything.
Exactly. I appreciate that. No, for sure. And tell me about some of the other books that you've written that have become bestsellers and, kind of what the content is.
Yeah. So in the beginning, I started with science fiction because I thought I was going to be the next Stephen King. And those books did really well in the grand scheme of things. I had a book called Time Heist. That was my very first book. And it was part of a series called The Firstborn Saga. That's probably the series that I'm most well known for. The other books in that series were Mind Breach and Soul State. It's all about cyberpunk, robots and AIs becoming sentient and taking over the world. And I just really love William Gibson's Neuromancer or Richard Morgan's Altered Carbon, which was adapted to a Netflix show recently. So really love that world. Haven't written fiction in a long time though, because one of the things I started to realize was I love writing fiction, but I didn't feel like it was helping anybody fundamentally improve their lives. At its core, it provides escapism. It gives entertainment. It gives people a little bit of relief from their life and allows them to connect into this world. But I found for myself, I wasn't finding that very fulfilling after a certain point. After books 10 and 11, I was like, oh, this is all just kind of the same, helping people escape. And so I got more interested in creating content around my struggles with ADHD and the things that really helped me get out of my own way so I could start tapping into that greatness that I kind of felt I had inside. I think everybody believes they have greatness within. Nobody really believes in their heart of hearts that they're born to be average, that they're on this planet just to be ordinary. Everybody kind of thinks they're extraordinary, has at least the potential for it. And I think the frustration that a lot of us feel is sensing that potential, but not being able to tap into it. And so over the last few years, I've been creating a lot of content on the YouTube channel, and we have a podcast around helping share the systems, the habits, the frameworks, the routines, the tools that have really helped me scratch the surface of that potential. And so I find that very, very fulfilling. It's been very rewarding. If people want to learn more about that stuff, we have a very, very large YouTube channel. You can just Google my name, Anthony Vicino, on there, and there's a ton of free content. So hopefully that brings somebody a little bit of value if they're currently at that place in their life where they're like, man, I feel like I've made for so much more than this. I feel you. I've been there. Even to this day, sometimes I feel that way too. So never really goes away.
Right. No, that's great though. That's great to have some strategies and ways to kind of overcome it. And so another great recommendation. And how about the relentless pursuit of less but better? What do you mean by that?
Yeah. So one of the most influential books I've ever read, it's the book that I gift the most often. It's called Meditations by Marcus Aurelius. And in there's a line that he says that to live a life of fulfillment, the goal, it should be to do less but better. And what I've taken that to mean is that instead of trying to do everything and trying to be everywhere and trying to fill up your to-do list with all of the million things that you could do, strip it down and just focus on what are the actual few things in life that matter most. Because we've all heard Pareto's principle, the 80-20 rule, that 20% of your inputs account for 80% of your outputs. And if that's true, why spend any time focusing on anything outside of that 20%? That's the big question, because that's where you're going to get the maximum leverage. And it's so hard because those 20% of things tend to also be, by definition, the hardest things to do. They're not emails. Yeah. They're not scrolling social media, right? Those things that are easy to do in the moment typically do not set us up for a life of success in the future. The things that are hard in the moment, that take a ton of energy, and there's a delayed gratification between when you put in the input and when you actually see the result of that input, it's very, very long. And so the more we can focus, and at least what I found is the more we can focus on those things in the moment that we know are going to have the highest leverage effect over the long term, then we can strip away a lot of the nonsense from our life and not feel like we're on the hamster wheel of life, just trying to run faster and faster and like making it through the endless to-do list, when really all that typically matters in a day is like 3 things. If you could just distill down what are the 3 things you could do today that would move the needle the furthest in your life, and just focus on that and let the other balls fall, like you would make more progress than if you just tried to keep all the balls in the air, but never actually move any of them forward.
Yeah, that's kind of the principle. I don't know if you've read 10X is easier than 2X, but it really falls right along that line. I mean, it's more about taking and removing things versus adding more or doing double the work.
Is that Benjamin Hardy and Dan Sullivan?
It is, yeah.
Yep.
That's a great one.
Yeah. 10X is easier than 2X. This gets into another concept that I first read from Steven Schwartzman, who was like the founder of BlackRock and Blackstone. In his book, What It Takes, he talks about how it's easier to build a $1 billion company than it is to build a $1 million company, because the $1 billion company attracts A-level talent. And that A-level talent allows you to grow and scale and gets the team motivated to run after the goal and build this incredible thing. Whereas $1 million opportunities only attract mediocre talent in the grand scheme of things. Like, it's really hard to build a $1 million restaurant, because at the end of the day, like your margins are thin. You can only rally the team so much. But building a $1 billion restaurant franchise, now you can start bringing in some really, really incredible people onto your team. And it just forces you to think larger. And typically by thinking larger and shooting for those bigger goals rather than aiming low, like you tend to, if not hit the big goal, you definitely still outperform the low aiming goal. It's like that whole shoot for the moon. And even if you miss, you still land in the trees or something.
Land in the stars. Yep, for sure. Yep. Yeah, no, fantastic. And I just got maybe a couple more questions for you if you have some time, Anthony. One is what I ask all my guests, and that is, and obviously with your amazing story, you may have some really good insight here, but if you were to being just getting started again, what recommendation could you maybe give for somebody who is just starting out and trying to find their success?
Yeah, so I actually did a video and a long article on this very topic, which was called, what was it called? It was like how to make $1 million on a low salary. And it was like trying to put myself back in that position of like, if I was 22 years old or 32 years old and kind of like just starting this wealth building journey, like starting to play that game more seriously, what would be the steps that I would follow? And it all starts with finding high value skills. You are, as Elon says, you're paid in proportion to the magnitude of the problems that you solve. So if you're not making what you want to make, it's because you're not solving big enough problems. You need to go solve bigger problems or solve small problems, but do it at scale. And that's really the only way. If you're not making what you want right now, it's because you don't really bring enough value to the marketplace. And this was something that I really got smacked in the face with when I started on my wealth building journey. I sat down with a mentor and I was like, I want to make more money, but I'm doing all this stuff. And he's like, truthfully, the problem is you're just not worth that much. Like, you're just not that good. Your skills suck.
Yeah.
And the skills that you do have, they're not worth much. And so you need to evaluate what are the skills that actually matter in life. And for me, you can distill a lot of it. Like, the way I think about it is that there's tactical skills, and which are like, these are how you make the money, right? These are the hard skills, like copywriting, coding. And then there's the soft skills. Those are the skills that are harder to quantify, harder to measure. And those are things like communication, discipline, charisma, right? And those are skills because you can train, you can become better at them. You might not be the most charismatic person in the world, but I can teach you how to smile, how to shake a hand, and I can teach you how to tell a joke, make you more charismatic, right? So in both of those things, you need to be working on your technical skills that are going to actually make you the money, but then the soft skills that are really the foundation for those hard skills to build upon. For me, I think a lot about things like discipline and focus. Those are two of the most important foundational soft skills that you can establish. Because if you have the ability to focus and hold yourself accountable, which is discipline, to doing the tasks that need to get done, then the the hard skills are just a matter then executing. And those can be all sorts of things, honestly. Like, there's tons of ways to make money. But in my estimation, if you're just starting out, the easiest way is getting into sales. Learn sales, because sales is really just communication coupled with influence. And influence, the goal is to move the audience to take an action, right? If you can do those two things, whether that's in the written format or through the spoken word, you can do pretty much anything. And so start by getting into a sales position, get the reps in. I prefer trying to sell something that's expensive, like a car or a house, because pretty much the same amount of effort goes into selling a house as selling, a blender, right? I find it's just as hard to sell $1 million item as it is to sell a $10 item. Same amount of objections that you're going to get. It's really just a matter of the difference of avatar, who you're selling to. So you might as well go for the high commission offer and really start to hone that skill, because once you have that, it's going to serve you well in everything in life, because you're going to be able to effectively communicate and influence people, which is two of just the most powerful skills that any human can have.
Yeah, I think there's a lot of truth behind that, and that, at the end of the day, it's, I forget who says it, but basically, everybody is in sales. Whether it's sales with your significant other, trying to convince them this or convince them that, selling your kids on something, whatever it may be, everybody truly is in sales. So, ultimately having a foundation in that is important. So great advice. Appreciate it, Tony.
If you think about what we're doing right here, if for the audience listening into this, you ask yourself, okay, what's their motivation? Why is Keith here? Why is Anthony here? Well, Anthony is here for all sorts of nebulous and self-serving reasons, I'm sure, right? But I'm trying to sell you on my story and who I am and what I do. That might be so that maybe you come invest with us in the future. Maybe it's so that you go and you check out another piece of our content, and maybe that has the ability to help improve your life in some way, right? So if I can sell you on my ideas or my story, and that maybe there's a way that they can help you, set you up more likely to go and actually do those things. Everybody in every context is trying to sell something. And once you understand that selling itself is not evil, if you stand behind what you're selling, the reason people associate negative feelings towards sales is because they think of the used car salesman who knows that they're selling a piece of crap car. If you don't believe in the product that you're selling, then sales is icky and gross. And yes, it should be shunned. But if you truly believe that what you have to offer the world or that other person could make their life better, then you have a moral obligation to that person to be as persuasive as you possibly can be, to get them to do the thing that you believe is going to improve their life. And so sales is a way of fulfilling that moral obligation, which is a very high, I don't mean to make sales sound like this like religious calling or anything like that, but I do believe it's very, very important. And if you look at it through that lens, then it can transform the relationship that you have with this idea of influence, right? The only difference between influence and manipulation is the belief that you have about what you're selling that person. If the person across from you had all the information that you have about the product and they would not then make the sale or make the purchase, that's manipulation. You are using your knowledge and their lack of knowledge to sell them something, right? But if they had that knowledge and they wouldn't buy the thing, that's manipulation. If they had the same amount of information as you did, and they would then choose to make that sale, then that's influence, right? And that's where we're trying to get to. Have the thing that you know can improve people's lives. So a little bit of a tangent.
Yeah. No. Perfect. Hey, no, it was a good one though. So I appreciate spending some time with you here today. I think you've added a ton of value to our listeners, and I know that we'll have some folks reaching out. But I appreciate it, Tony. Thank you so much.
Absolutely. It's my pleasure, man. I really appreciate you having me.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.